Hello, everyone, and welcome to our Pellegrini Financial first quarter market call for 2021. And I know as a whole, everyone I think was pretty anxious to get through 2020, end of the year, and wash their hands of it and start with a clean slate. So here we are, 3 months in, 4 months in now, and kind of still feels the same in many ways. So hopefully that turns around as time goes by. I know what is a little different, of course, from 2020 versus 2021 is in the start of this year, of course, markets have performed far differently than the prior year. So 2020, if you remember that year, 21, um, basically we started the year off quite well, and then we had that dramatic fall in March to end the first quarter. This year, it's kind of been the exact opposite to some degree. We had kind of a flat negative market in January, but where markets took off in February, March, and through April here now, and turned out to be a pretty good year to start off with. So from a market performance standpoint, things have been pretty solid, all kind of on the expectation of this unleashing of a post-pandemic, I guess, demand and economic growth, which everyone is kind of angling for. When we look at the actual markets and indices in particular, I guess what else is different too is that the TSX or the Canadian market has led the way in regards to equity returns. S&P 500 or the U.S. market actually trails close behind, although after currency, there's a bigger gap there. And even the Asian European markets have been up, and the Asian market or international markets have been up as well. What was a negative has been the fixed income space, and that interest-bearing market or sector is the aspect that has um, provided some negative performance, I guess, or been a bit of a drag on overall performance. When we look at industry sectors or performers, energy has kind of led the way. This is kind of similar to US and Canada. And energy stocks, of course, which have been beaten down over the last number of years, had a good and pretty robust growth in this last quarter. Obviously, there's a ways to go yet before they get back to pre-pandemic levels, but it was good to see a nice rebound in the energy sector. Financials, materials, real estate were also good performers. And technology, which has kind of led the way for the last couple of years, has been a positive performer, but more on the lower end of the scale this time around. And ultimately, that will return as well. Technology is not going away, so it'll be a big part of future growth. When we look at commodities, I mean, the oil price, of course, is one of the main drivers behind the energy performance. And that surprisingly, oil jumped quite dramatically after the Texas freeze in particular. And at the same time, roughly, the Saudis announced an extension of production cuts that the market wasn't expecting. So markets drove oil through 60 into 65 very quickly, fell back below 60 later in the quarter, but then has bounced back up to where it's around $65 again today, which is much higher price than expected. Copper, I mentioned copper last time around as well, but that has continued to run, which is a good indicator for economic growth. Interest rates, this is kind of a discussion here on interest rate yields and the spread between 10-year government bonds and 2-year government bonds. So it's not interest rates per se, it is the spread. And I drew a red line there at the start of the quarter or start of the year now to kind of illustrate the kind of rapid rise of longer term interest rates. So more normalizing of the yield curve. And long term, that's a good thing in different ways. But short term, that causes pain. And that was the negativity we saw in the fixed income space here in this first quarter. So as interest rates rise, bond yields can come down, and that creates some negativity. Shorter term in nature, I think. When it comes to inflation, inflation has been pretty steady here through the year. I guess that's a tougher one to evaluate because we have seen, of course, locally, you see big inflation increases. If you're buying lumber, and I just did, it's expensive. You see other products that are more expensive too. Microchips globally are more expensive, and a lot of these things are supply issues or interruptions to manufacturing processes that caused a short of supply, and of course, prices increase. A lot of experts think this is more transitory kind of inflation, not structural or permanent in nature. Time will tell because that's where the other half of the camp lies. Currency-wise, this is kind of an extension of the graph from last quarter as well too. But I really want to highlight this recent jump in the Canadian dollar versus U.S. and that's what this one is looking at. And so, we started the year, 78 cents and 77 cents in that mark, and then of course it's up to 81 and a half now, and been a steady climb all the way since last spring. And that expectation, I think, is that to continue. Of course, that is influenced a little bit by the price of energy and commodities and metal prices and so on. And our trade surpluses have kind of come back into play as well. But the expectation is the Canadian dollar to continue to appreciate against the U.S. and maybe other currencies as well. So where we go forward, I guess I think, as I point out in the slide here, the vaccine distribution is still key, regardless. Obviously, to get everyone back to normal and living life in our usual ways, that's a big part of it. Fiscal stimulus remains from the central banks. I think you'll see again continued strength in the loonie and seeing that continue to appreciate. And the growth in demand returning to pre-pandemic levels. I don't know if we'll get there that fast in regards to this calendar year. I guess the issue is markets are certainly pricing that in. The markets are certainly pricing us getting back to a bit more normalized here by summertime and through the rest of the year. So the key is, does the market truly reflect the economic growth? Does the economic growth finally catch up to markets, perhaps? That'll be the question, and that's something we'll be watching as we go forward here through the rest of this year. So I do want to thank you for joining us. I know this was a quick call, and at any time, if you have questions, comments, or concerns, certainly feel free to call any of us here at the office, and we'll gladly talk you through them. So once again, thank you for joining us, and until next time, enjoy your spring.